VanEck Vector's Australian Equal Weight ETF, or MVW, is a unique exchange-traded fund ETF that gives you exposure to Australia's largest companies, but with a twist. It uses an equal weight strategy, not the traditional market cap weighting. This means every company in the portfolio has an equal share, giving smaller companies more influence compared to typical ETFs. What does MVW do? MVW tracks the MVIS Australia Equal Weight Index, which includes 80 of Australia's top companies across sectors like financials, healthcare, materials, and consumer goods. Instead of being dominated by a few large companies like Commonwealth Bank or BHP, MVW spreads the investment equally across all 80 companies, providing more balanced exposure. This approach reduces concentration risk, where market cap-weighted funds can become overly dependent on a handful of large companies. Why invest in MVW? MVW is designed for investors seeking broad Australian market exposure with better diversification than traditional ETFs. It's great for long-term investors who want to avoid over-reliance on large-cap stocks while benefiting from potential growth in smaller and mid-sized companies. Example of how MVW works. Let's say you invest $1,000 in MVW. Your money is equally distributed among 80 companies. This means smaller companies like ResMed or Domino's Pizza have the same weight as giants like Commonwealth Bank or BHP. If one sector, like financials, underperforms, the equal weight strategy minimizes its impact on your portfolio compared to a market cap-weighted ETF. This provides a smoother and more diversified performance. Benefits of MVW. Equal weighting. Every company has the same influence on the ETF, reducing the dominance of large-cap stocks and providing better diversification. Broader growth potential. Smaller and mid-sized companies can contribute more to the ETF's performance, offering growth opportunities that a traditional ETF might miss. Diversification across sectors. MVW includes companies from a wide range of industries, lowering the risk tied to any single sector. Reliable dividends. Many companies in the ETF pay dividends, providing a steady income stream. Moderate fees. With a management expense ratio, MER, of 0.35%, MVW's fees are slightly higher than traditional ETFs, but reasonable given its unique strategy. Risks of MVW. Sector exposure. While diversification is a strength, Australia's market is still heavily weighted toward financials and materials, which can impact the ETF during sector downturns. Tracking risk. Equal weighting means MVW's performance may differ significantly from traditional market cap indices like the S&P ASX 200. Higher fees. MVW's MER of 0.35% is higher than some market cap-weighted ETFs, which might reduce returns over time. Is MVW right for you? MVW is ideal for investors seeking a balanced approach to Australian stocks with less concentration risk. It's a good fit for long-term investors who want exposure to a wide range of companies, including mid-sized firms with strong growth potential. Its equal weight strategy makes it a smart option for those looking to avoid over-reliance on large-cap stocks.